Hello and welcome to our step 4B about the business economics CLIL course on our company Candyland. So today we're talking about the markup analysis. But basically, first we have to talk about margin. Margin is a difference between the selling price P of a product and its cost. There are various ways of computing margin, okay? Sometimes you don't have a full picture, so you are restricted and you look into just a portion of the margin. Sometimes you have the total picture and you want just to understand how much money you can make per unit of product. Anyway, everything computed as a difference between P, the selling price, and the type of cost, can be variable cost per unit, or the direct cost, or the average total cost, well, we call it markup. First, we talk about the markup on the variable cost per unit. It's an incredibly important number, and it's called the contribution margin per unit. Why? Because when you are doing a break-even analysis, you will see that the CMU, the contribution margin per unit, tells you a very important story, i.e., how much money you can make per every product produced and sold that can be used to cover your fixed costs. You remember, fixed costs are there and have to be covered no matter what. So the higher the contribution margin per unit, the more you produce, well, the more money you have to cover your costs, even your fixed costs. And after a while, well, you reach a point where from that point onwards you are not just covering costs, you're actually producing a profit. Okay. Another very important aspect of the contribution margin per unit is that if by any chance the CMU is below zero, it means that your price, your selling price, is below the variable cost per unit. It means that you are selling your products at a price which is lower than the amount of costs, variable costs, that you put into that product. Imagine, like if you're putting 4 cents of aluminum per aluminum can, and you're selling your can at 3 cents. So the more you produce, the more you lose, and production should stop as soon as possible. Okay? Well, what about the margin and the markup on direct costs? The difference between the selling price and your direct costs indicates the amount of margin per unit sold available to cover indirect costs. So all administrative expenses, marketing, all costs that are not directly attributable to a certain production line but can be allocated to them so that each product has to contribute to cover them. Okay, so the bigger the direct margin per unit, the better the gross margin. Also in this case, if your selling price is lower than the direct costs, you will have a negative direct margin per unit, which means again that you are putting glass into your bottle that costs more than the price of a bottle. Well, in that case, you are better off stopping right away the production of your glass bottles. You'll save money. Okay, the direct margin per unit is absolutely important in order to compare the profitability of different products and to see how much they can contribute to covering these indirect costs that weigh on the company. Now, what about the markup on the average total cost? Well, that's the principal way in which you might think about markup. Once you have done all your calculations, you know that your aluminum can costs 15 cents to produce. And so how much are you making out of each can that you are selling? Well, you must know the selling price. If you know your average total cost, you can make a difference, and the difference between price and average total cost gives you exactly the margin, okay, markup on average total cost. Well, there's also another catch here. we have seen that if your price goes below your variable cost per unit or your direct cost, you are better off stopping production right away. Not in this case. Why? Well, the important thing is that if you are losing money but you are managing to cover part of your fixed costs, well, in that sense, you are actually saving money. So, the margin and the markup of an average cost is fundamentally important for a company because it tells probably the fortune of the company. The higher, the likelier is the company to be a success. In practical terms, usually the markup is expressed as a percentage of the average total cost. So we know that the price is given by our average total cost plus the markup. We can express everything as a percentage of the average total cost. Okay? In that sense, we have transformed an equation with 3 variables in an equation with 2 variables. Easily solvable. What about the markup as a percentage of price? Well, often it is expressed as a percentage of selling price, especially in commercial enterprises. What we have here is that price is equals to the markup plus the average total cost, but the markup is not expressed as a percentage of the average total cost, but as a percentage of price itself. So, markup as a percentage of the price is larger than a markup as a percentage of cost. Why? Think about the example I put down. Imagine that you are selling your products with 50% markup on the average total cost, okay, which is 10. So you have 10 euros plus half of 10, okay, plus half, the margin is half of your costs. So 10 plus 5 is equal to 15. This is your selling price. But what if you are selling it with a 50% markup on price? So your average cost is always the same, 10 euros. But this time you are adding a markup which is half the selling price. With a selling price that basically you can solve the equation and see that the actual final price will be 20. So in the first case you are selling it at 15. But here to have 50% of the price as markup, you have to increase your price from 15 to 20. Clearly, markup is the key to profitability, but without positive margin markup over direct costs and over variable costs, you'd better stop production right away. So either your contribution margin per unit and your direct margin per unit are bigger than 0, or you can stop producing right away. Remember, the higher the markup, the higher is also selling price, respectively. You know, even if you compute it as the same percentage on price instead of on cost, it will be even higher. So always make sure that the price you want to sell your product at is in line with the demand for your product. Everybody would love to make a 90% margin, okay, product, but not everybody is able to do it. Why? Because there's always a competition waiting to eat your lunch. So don't be too greedy and be careful. And with this, I finished my discussion about markup. We'll soon see each other on step 5 of our Candyland CLIL course in business administration.